Passive income is not effortless. It is
Open up any financial feed and you will find influencers highlighting assets with 10 or 20% payouts. They present these high-yield distributions as a shortcut to escaping the traditional 9 to 5. Buying into the highest advertised headline yield ignores the underlying mechanics of the asset, leaving an investor exposed to the eventual decay of their initial capital. A 7% yield attached to a business with a declining market share erodes net worth, whereas a 2% qualified dividend from a growing company built it. We see the cash entering the account every month, yet the total account balance continues to move downward. The distributions are effectively offsetting a loss rather than creating new wealth. Understanding how this happens requires us to look past the surface-level income yield and calculate the actual total economic return. Our 2026 macroeconomic baseline is defined by high friction. Inflation remains sticky above 4%, while borrowing costs are structurally elevated. This chart shows how inflation attacks high-yield corporate bonds. A 7% payout sounds substantial, until 4.2% inflation consumes the return. Over a 5-year period, the real value of the principal investment decays alongside the purchasing power. In a high-inflation environment, an exceptionally high yield often serves as a defensive hedge against currency devaluation, rather than a source of growth. The U.S. tax framework imposes different rules on different income streams, which significantly alters the final amount of cash that actually stays in your pocket. Passive assets like real estate investment trusts, or REITs, and digital royalties are generally taxed as ordinary income. This places them in the highest marginal tax brackets for most investors. A 10% yield taxed at ordinary rates is reduced by nearly half, while a 2% qualified dividend benefits from lower capital gains rates. Because it is tax efficient, the dividend's underlying capital compounds much faster over the long term. A massive headline yield provides no benefit if the tax code prevents that money from ever being successfully reinvested. High-yield digital and alternative assets often involve unseen structural dangers, ranging from platform dependence and operational code debt to simple credit defaults. Lenders on P2P platforms or buyers of small software businesses accept these high yields as a direct premium for the significant probability of a permanent loss of their capital. If an asset pays 10% in cash, but the underlying value drops by 15% due to shifting search algorithms or tenant defaults, the investor has effectively lost 5% of their wealth. Standardized government assets represent the opposite end of this spectrum. This U.S. savings bond carries a contractual guarantee that the stated monetary value will be preserved and returned to the holder. High cash distributions often mask the reality that an asset is simply liquidating your own wealth and paying it back to you in smaller installments. Generating sustainable passive income requires a deliberate portfolio architecture rather than a series of isolated high-yield product choices. Constructing a non-fragile system involves a bottom-up execution protocol, starting with the most secure assets first. Step 1 and 2 establish emergency liquidity and a contractual core. By holding treasuries and bonds, you preserve baseline capital. Step 3 adds inflation-sensitive dividend equities and REITs that grow payouts as costs rise. Finally, we allocate to speculative, high-yield alternatives. The effectiveness of a passive income asset depends on how its risk profile and tax location match the specific structural job required of it. Building this machine methodically ensures your income remains passive. Without a contractual core, you are simply trading financial security for temporary cash.